personal finances, whether that be your 401 on the air to answer your questions. And this morning we have Davis Hingtgen, CPA, making his On the Money debut. We're happy to have him here. Davis, why don't you tell our listeners a little bit about yourself and your background?
Yeah, thanks, Dillon. Like he said, first time live on the radio, so we'll see how this goes. But yeah, I'm one of the newer folks in the CFG building. Like he said, my name is Davis Hingtgen. I born and raised here in Orlando. Love it around here. I went to college up in Atlanta, attended Emory University, got my undergraduate degree in business and master's in accounting. As he mentioned, I'm a licensed CPA, so I spent my first couple of years out of school working in public accounting in the Big Four, primarily doing large company audits. But after a couple of years, decided it was about time for something new. That's about the time I got connected with Gary Abley, who, of course, is another CFP in the building. And that got me thinking kind of about financial planning as a potential profession. And well, now here I am about a year later, live on the radio with y'all. So happy to be here. Want to introduce us to our topic, Dillon?
Absolutely. Davis is a very smart guy, and we're very happy to have him as a member of our team here at Certified Financial Group. So topic of the day is commonly missed items seen in a financial plan. So Davis and I do this day in and day out. We do a lot of financial plans for a lot of people who are clients or interested in becoming clients, people who are eyeing to retire. So we thought it'd be helpful to kind of list out some of the things that we commonly see missed when people are doing projections about, their finances. So start off with a quote by Benjamin Franklin: "By failing to prepare, you are preparing to fail." So we'll start off, why do people generally get a financial plan? Well, if you're eyeing retirement, it's around the corner. You may want to see, do I have enough money to retire? Maybe you want to see the longevity of your money, see if there's any pitfalls that you've, missed along the way, so you can reach specific goals such as legacy goals, gifting, travel plans, etc. So I'd say to start off with, the biggest thing that we see missed in a financial plan is not accounting for inflation. Inflation can eat away purchasing power. We're seeing some hot inflation right now. Over the last 50 years, inflation has been closer to 50% higher than what we're seeing currently. Last 50-year number is about 4%. Last 30 years, it's about 3%. And our projections, we use 3% as well, because we kind of take the midpoint of what we've seen over the last 50 years and what the Federal Reserve's target is of 2% and kind of use that midpoint. Is that a good number? We're not sure. You have to put a number on something. But that's kind of what we're seeing now. And obviously, due to the recent data that's come out with inflated oil prices, we're seeing inflation run much hotter than that. Secondly, kind of on the topic of inflation, is healthcare inflation. So when Davis and I are doing financial plans for our clients, I just said we're inflating expenses by 3% annually. We kind of separate out healthcare inflation as a separate line item entirely, because generally speaking, these healthcare costs go up at a much faster pace than general expenses. For example, last year, Part B Medicare premium, Part B Medicare deductible went up by 10%. Medicare supplement plans, group health insurance plans, we've seen go up by as much as 20%. So with that said, it's kind of unrealistic to assume that these costs aren't going to continue to rise. We have somewhat of a broken system in our healthcare system. What do you think, Davis?
Yeah, inflation is here, and it's very real. I think we're all experiencing it, no matter where you are. Whether it's at the pump, whether it's at the grocery store, it's very real. And I think, to your point, it's very important to kind of bifurcate the different expense items and how they change over time, because energy changes at a different rate as healthcare, like you mentioned. I think everyone's getting hit by it. And, I think it's easy especially if you're maybe a do-it-yourselfer, when you're putting together a budget, you say, okay, these are my typical expenses, and I'm just going to spend at this rate constantly over time. And it can be easy to leave out something as crucial as inflation, but it's a very important thing. Otherwise, you're probably going to be a little bit misguided as far as how long your money can last and when you're safe to retire.
Absolutely. And if you're doing this on your own, we see a lot of people come to us, with their spreadsheets of all their projections and everything they've calculated out themselves. And I would say the biggest missed item on somebody's spreadsheet that they may bring us is not accounting for inflation. Kind of on a similar topic, one of the biggest things we see missed, somebody's been successful in their career. They may want to retire early. Let's say a couple comes to us in their mid 50s. One of the biggest missed items is pre-Medicare age healthcare related costs. As many of you know, we've seen a lot of the Obamacare, Affordable Care Act subsidies kind of be a little bit diminished starting this year. So if you're buying a policy on the exchange, it is much more expensive now than it has been in previous years. We've seen policies range anywhere from $15,000 to $24,000 per spouse. So if you're retiring at age 55, you have 9-10 years before Medicare, spending anywhere from 35 to 50,000 a year on healthcare costs. And as I just said previously, inflation long term is running about double what general expenses are. So that's in today's dollars. So a strategy we're kind of seeing become more popular this year for people retiring before Medicare age is people retiring at age 63 and a half. So with that strategy, if you work for a company with more than 20 employees, you can elect what is called COBRA. So what that is generally 102% of your group health insurance rate that your employer, can provide to you. And that is generally much cheaper than buying a policy on the exchange. It's becoming very difficult to do that recently.
Yeah, this is a really important topic to bring up. I think as I've started here at CFG working with individuals, couples, that post-retirement pre-Medicare health insurance is probably the thing that's surprised people the most. Earlier this week, we had a young couple come in who's doing really well, and they have this goal of retiring early, probably like in their mid-50s. And when we started mapping out just how much that their health insurance and health expenses would cost in those years between retirement and Medicare, it really blew them away. It's crazy. You were saying up to about $24,000 per spouse. That's a significant amount of money to be spending on your health insurance and on your body. So to your point, it is a commonly missed item, and it is a very large and impactful missed item in a financial plan.
Absolutely. And then another big thing that we see missed is kind of not really taking Social Security into consideration in the right context. So some of the commonly missed mistakes that we see, somebody thinking, well, I've read the report from the Social Security trustees that, the excess trust fund will be out of money in 2033, so I should claim now and get my money now because I've been paying into this system. So claiming too early can be a huge mistake. If you can afford to defer and you're healthy, we generally recommend waiting until 70, at least past your full retirement age. So claiming too early, that is a decision for life, essentially. That could really blow up a retirement plan because, you may think that Social Security may not be there for you. As another big mistake we see is when you get your Social Security benefit estimate in the mail, Social Security takes in your highest 35 years of earnings and indexes them for inflation. So what you earned last year, Social Security is going to assume that you earned this year and next year and so forth in the projections that you see on your statement. So if a couple's retiring, in their early 60s and they're planning on waiting until 70 for Social Security, the benefit estimate that they see for age 70 on their statement, is probably a little bit rosy. And because they're going to have, ages, let's say 62 to 70 of future zero earnings, their actual estimate is going to be a little bit lower than that. So you can go on to Social Security, SSA.gov. You can tell it to, tell your earnings to be future zeros and it'll recalculate your benefit. Or we have some access to some pretty cool software where you can send your XML file of your benefit estimate. We can kind of plug it into some pretty cool software, make different assumptions on income, zero earnings between now and retirement. We can tell you, break even point of, when you should claim at different ages, what the maximum strategy would be for a couple, assuming different life expectancies. And it's some pretty cool software. And it's definitely something that is worth doing, because this is one of those decisions that, again, you really can't go back on very easily and could impact you for life.
Yep, and that's, in my experience, that's one of, if not the first question that usually gets asked when folks come in who haven't filed for Social Security yet is, when should I file, and is there going to be anything for me by the time that I do? It's a very important question. Like Dillon said, once you make that decision, that's your decision for life. But I hear the bumper music coming, so Josh, why don't you take it away?
Now that is a segue of not a novice, Davis. You got this already in the bag. Talking about bumper music, toss the break. I got you, Dave. If you've got a question for these two experts, these two CFPs, I got a phone number for you to write down: 844-580-9326, 844-580 WDBO. We also got a couple other options to send in your questions, your comments. The open mic feature inside the WDBO app, along with the group chat on the website and in the WDBO app. Just text in your question like the old chat room days, which Dillon and Davis may not know what those are back in the AOL days of the 90s. Again, 844-580 WDBO. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
Has been chosen once again as one of the top 100 financial advisory firms by CNBC out of nearly 40,000. And because they won't divulge the selection criteria, asked my colleagues what they thought.
Maybe it's because our history dates back almost 50 years.
Could be because we're independent, but we custody with national firms like Fidelity and others.
17 CFP professionals under one roof.
Or it could be because we're CFEX certified.
And a real person answers the phone.
In any case, we're proud to have been selected. So if you're looking for financial planning or investment advice for a fee, look us up online. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in, you say, "Hey Lou, I need to, I'm barbecuing this weekend, right? What do you like?" And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best.
You on the money here on WDBO AM 580, always streaming inside your WDBO app. My name is Josh McCarthy, sitting here today with Dillon Little and Davis Hingtgen of the Certified Financial Group. If you've got a question for either of these two CFPs, Certified Financial Planners, pick up your phone and dial 844-580-9326, 844-580 WDBO. A couple options otherwise to send in your question or comments. We got an open mic inside our WDBO app, conveniently labeled open mic inside the WDBO app. Find the bottom right-hand corner of that, open app, and send in your question. Hit record, send it on in. I'll push play as if you're sitting here in studio with us. Dillon and Davis, back to you and our topic of today, which is commonly missed items in your financial plan.
Absolutely. So kind of where we left off, so kind of some more commonly missed items that Davis and I see day in and day out when we're doing financial planning for our clients. Next one on the list is realistic return assumptions. So over the last 100 years, stocks measured by the S&P 500 index have done about 10%. Over the last 25 years, they've done closer to 9%. So we're 17 years into this bull market. We define a bear market, conversely, as a decline of 20% or more in any major index lasting at least 2 quarters. So technically, we have not seen that since March of 2009. So we are 17 years into a bull market, as I had mentioned. So, Davis, I don't know what your crystal ball says. I don't know when the next bear market will be, but I can say it's probably 17 years closer to the next one than we are from the previous one. So we kind of want to be realistic about, what returns can we expect for our investments moving forward. So when we are doing financial planning for our clients, we kind of use a weighted average approach between how much somebody has in stocks, equities, bonds, fixed income, and cash. So Davis, what do we assume for rates of returns on these asset classes when we're doing financial planning for our clients?
When we're doing our planning, we look at 8% for stocks, 4% for bonds, and typically 1% for cash. And I think One important thing to consider if you're trying to project out your money is that, these are the average returns, but we are very rarely actually going to get an average return. If the average return for stocks is 8%, more likely than not in a given year, we're going to get, a 20% return. And then the following year, maybe it's down 5%. The stock market is anything but smooth increases over time. So it's important to set realistic expectations, and it's important to be able to handle and be able to stomach that volatility when the markets get going a little crazy.
That's a great point, Davis. As he mentioned, we really don't get averages very often. As I said, over the last 100 years, the stock market has done 10% a year on average. We've had 38 out of the last 100 years be returns of over 20%, where only 6 out of the last 100 years a decline of over 20%. So markets are up, markets are down. Over the long term, we receive these averages, but very rarely do we receive an average return in any given year. I see we're coming up against the bumper music again. Take it away, Josh.
You got it. 844-580-9326 is the number to call. 844-580-WDBO. Send in your open mic. Send in your group chat. We got Dillon Little and Davis Hingtgen here answering your questions live on the air. Also got Wynn Smith taking calls off the air. If your question is a little bit more personal, if you want to get straight to the numbers and you want to skip the on-air public part of this whole process, Wynn Smith available to you at 407-869-9800, 407-869-9800. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak, just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit, it's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes
And welcome back to On the Money here on WDBO AM 580, always streaming inside your very own WDBO app. My name is Josh McCarthy, sitting here with Dillon Little and Davis Hingtgen of the Certified Financial Group, two certified financial planners taking your calls as the Certified Financial Group has been doing so for nearly 4 decades on the airs at WDBO. If you've got a question, pick up the phone now. 844-580-9326, 844-580-WDBO. Send in your question on the open mic if you like that inside the WDBO app. If you're more of a keyboard warrior, go ahead and head to the WDBO website, and we got the group chat option available for you there. 844-580-9326. And we'll head back to the topic of today's show, commonly missed items in a financial plan. Before we get to that, Dillon and Davis, when I was filling out my financial plan, I must have missed the option to click this box for $1 trillion like Elon Musk did last week. So yes. I just want to make was that my doing, or does only Elon have that option on his plan?
I think so, at least for the time being. Yes, as Josh mentioned, Elon Musk became the world's first trillionaire yesterday with the SpaceX IPO, which has been heavily coveted in the financial news. Also, just want to mention that to our listeners, if there is a call you would like to call in with a question and you do not feel comfortable, discussing this on live air, we do have Win Smith, CFP, here in our office to answer your questions. Number to call is 407-869-980. Again, that is 407-869-980. We have Win Smith here in the office to answer your questions. kind of where we left off with commonly missed items we see in a financial plan. This is a big one, especially if you work for a large company, is concentration risk. Now, Davis, what do we mean by concentration risk when we're doing a financial plan?
Concentration risk is when you have a large percentage of your portfolio allocated to a specific stock. So I think typically, we say we want to have everyone below or have no more than 5% in any one company. Does that sound about right, Dylan?
Say for an aggressive investor,
Right.
that sounds about right to me.
Okay. Yep. And the reason for that is, well, in the good times, concentration can be great. You can see huge returns, double your portfolio, but when times aren't so good, all it takes is, one company in your portfolio to really weigh you down.
Yeah, I'm going to pick on Intel here for a second. So take a journey in time back to August of 2000. Intel is the 5th largest company in the U.S. stock market at that time, kind of peaked in price around then. So if you would have held Intel, which was one of the largest companies at that time, you would have been underwater in your investment. In other words, your Intel stock would have been down in value until this year. So 26 years, you would have been down in value if you were heavily concentrated in Intel stock. So it's very important, as David mentioned, not to have too much concentration in any one company, diversify among different sectors, different asset classes, and so forth.
And I think an important thing when you point out the example like Intel, it would have taken you, 26 years to get your money back. But I think we all know human behavior, and we know that if someone were down on a stock that whole time, they probably would have sold out at some point thinking that it was a lost cause. So very important to diversify your positions. I think it's especially important to consider it now because, as we talked about a little earlier in the show, we are a long way into this bull market. So, it can be easy to think, markets are just going to keep going up and up, especially, people on the younger side, like our age, we've never truly experienced a bear market ourselves like we saw in 2000 and 2009. So I think it's easy to kind of get lulled to sleep and think, oh, even when you get blips like, when the market corrected a bit around when tariffs were first a thing or other situations, it's easy to think that, oh, the stock market is resilient, it'll always bounce back. But, as we've seen further back in history, that's not always the case.
And Davis, what do we see as the most common reason of why somebody does not want to deconcentrate themselves in any one holding?
A lot of times they get attached to it. I mean, I can imagine if you've been in a stock for a long time and it's done really well for you, you kind of think, well, why would I give up on it now? It's been great for me before. And I think a lot of times people will be over concentrated in a stock for a company that they worked for. Maybe they got stock options or stock grants from their employer. So they know the company well. They say, oh, the company is recession proof. It is built to last. But a lot of times that kind of emotional attachment or connection can kind of blur your vision a bit.
Rose-colored glasses.
Rosy-colored glasses, that's right.
I would add on to that, another reason why somebody may not want to deconcentrate their risk is taxes. If it's in a brokerage account, as Davis mentioned, it could be a stock grant or so forth. You're paying capital gains on the gain. If it's been a huge run up, you may not want to pay the taxes. I would just say to that, the risk of being concentrated is high. Especially if it's a large percentage of your money. And two, you generally speaking, you only pay taxes when you've made money. So, bird in the hand is better than two in the bush sometimes.
Folks around here like to say you'll never go broke taking a profit.
Exactly. So moving into the final, line item here of commonly missed items that Davis and I see in a financial plan is not planning for big ticket items. I think this is where Davis and I and the 14 other certified financial planners really add a lot of value to our clients' financial life. So Davis, I'll paint a picture for you. Tell me if you've ever seen this before. A couple comes to us in their 60s. We may ask them, who has the oldest car between the two of you? And they say, well, our cars are paid off. Well, if you're in your early 60s, you keep your cars for 10 years. Generally we see people in their 80s may move to one car. Chances are in your retirement, you're going to have 4 or 5 more cars, and we very rarely see this accounted for.
Mm-hmm.
So Davis, kind of how do we approach big ticket item planning in financial plans?
Yeah, so I think a lot of times when people come to us with their preliminary plans, they map out, all the stuff you would expect to see, how much they spend on food, on, utilities, expenses, all of that stuff. But we like to sit down with them and map out well into the future. Okay, we're kind of to your point, we're going to map out car purchases every 10 years going forward. And maybe at the age of 85, you buy your last car and you won't get another one after that. Other big ticket things that we commonly find missing is you're going to have to replace your air conditioning. That's very important here in Florida. You can't live comfortably very long without that. So we plan for replacements of that every 10 or so years. We got to get our roofs replaced. Hurricane season rolls around. You want to make sure you've got a good, safe roof to protect your house. So those are a couple of the things. Did you have anything else in mind?
How does Davis? How does tax planning kind of fall into this with big ticket item planning?
Yeah, it's very important. We want to map out, how their income is going to change over time. Maybe they're going to have a couple of years where they're at a low income bracket, so it'll be a good opportunity to maybe pull some of your money out of your traditional IRA via Roth conversions, take advantage of those lower tax brackets at that point in time to pay for some of your more big ticket items. Otherwise, I think this is probably something that Justin will talk about in his upcoming workshop, but where you pull your money from really matters.
Absolutely. And Josh, I think we had a text question come in.
We sure do. If you want to join the text question, you can open up that group chat inside the WDBO app. Go to WDBO.com/group chat, and you'll find the conversation there. Jim from New Smyrna writes in. Jim is 66 years old, and he's retiring at the end of this month. He's currently on an HSA plan at work, and he will be switching to Medicare when he retires. He wants to know if he can maximize his HSA contribution for this year, and his wife is already on Medicare.
Well, Jim, first of all, congrats on making the decision to hang it up this month. Congratulations to you. If you're on an HSA plan, something to note, in the year that you're making that change from your HSA plan to Medicare, let's say it's sometime in the year, in this case, I believe Jim said he's retiring at the end of this month, your HSA contribution is prorated. Again, it's prorated. So Jim would be, signing up for Medicare effective July 1st. His high deductible health plan, his HSA plan will drop coverage at the end of this month. So Jim, your HSA contribution for this year would be limited to 6/12 of the contribution limit. So that's $4,400 plus the $1,000 catch up, 6/12 of that. Your HSA contribution for this year would be limited to $2,700. Now, Davis, how should Jim's HSA be invested in relation to his other accounts?
Yeah, so how we typically advise our clients to use their HSAs is to not pay for their medical expenses immediately out of the HSA, but rather continue to pay for those out of pocket, because the HSA is unique in that you get a triple tax benefit of contributing pre-tax, and then you get all that growth over time is tax deferred. And then when it comes time to pay for medical expenses down the road, you get to pull your money out tax-free. So with that in mind, we like to use it. We suggest people invest fairly similar to how you would a Roth IRA. We want to see it invested very aggressively. Well, maybe I shouldn't say very, but we want to see it invested aggressively in comparison to how you would invest your other accounts. So companies or funds that we see as having a lot of growth potential to take advantage of that tax-free growth.
Couldn't agree more. And now, Davis, what do we mean by aggressive when we're saying that Jim's HSA should be aggressive?
I would say we want to be entirely in equities. We don't want to be having your cash sit idly in a money market or a bond fund. We want to be invested primarily in equity funds or entirely in equity funds to, again, try to take advantage of that tax-free growth.
All right, Jim. Well, again, congratulations on retiring. Hope that answers your question. Josh, I think we had another text question come in.
We do, and Megan writes to us from Windermere. Maybe I can ask the question now. We can head to break, and we can answer Megan as we return. Megan is asking questions about the Roth conversion. She has heard people talk about Roth conversions from their traditional IRA accounts, and she wants to know, why would I voluntarily pay taxes on a Roth conversion today instead of just waiting and paying taxes when she can take the money out later? So if you like, we can get that question here after the break. A question we all want to know. Speaking for the people, Megan. I love
All right,
that.
Megan, we'll get back to you.
To call in 844-580-9326. We got Win Smith taking your calls off the air. 407-869-9800. You're listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
CFG has been chosen once again as one of the top 100 financial advisory firms by CNBC out of nearly 40,000. And because they won't divulge the selection criteria, asked my colleagues what they thought.
Maybe it's because our history dates back almost 50 years.
Could be because we're independent, but we custody with national firms like Fidelity and others.
17 CFP professionals under one roof.
Or it could be because we're CFEX certified.
And a real person answers the phone.
In any case, we're proud to have been selected. So if you're looking for financial planning or investment advice for a fee, look us up online. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in, you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to, the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak, just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit, it's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token,
toss here. Back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. I got David Hingtgen and Dillon Little here, two certified financial planners with the Certified Financial Group. I'm Josh McCarthy, certified call screener for these experts here on the airwaves. If you've got a question for them, got just a few minutes left on the airwaves, 844-580-9326. If you've got a question, you want to skip the middleman, me, and go straight to Certified Financial Group, Win Smith. He's taking your calls live off the air as this episode comes to a close at 407-869-9800. 407-869-9800. Just before the break, Davis and Dillon. We got Megan who wrote in her question, and Megan says this. She says, I've heard people talk about Roth conversions from their traditional IRA accounts. IRA, if you're cool. Why would I voluntarily pay taxes on a Roth conversion today instead of just waiting and paying taxes when I can take that money out later?
Yep, and that's a great question, Megan. Thank you for sending that in. So to think of it simply, the reason is that sometimes paying taxes today at a lower rate can help you avoid paying taxes later at a higher rate. That's because, the goal isn't to avoid paying taxes forever because, correct me if I'm wrong, Dylan, we simply can't avoid taxes forever, at least
One
not
of the only
legally.
certainties of life.
Death, taxes.
Right.
So it's really about managing when you pay your taxes and how much you're paying. So if you believe that you're in a lower tax bracket now than you will be in the future, doing that Roth conversion and paying the taxes now can save you money in the long run. That's the short and sweet of it.
So in other words, Megan should fill up her low bracket if she's in one.
Right. We usually, for our clients, we'll look at, if we want to fill up the 12% bracket typically, which I've got my handy dandy tax bracket sheet here. If you are an individual, that is up to about $50,400 in taxable income. And if you are married filing joint, we're talking about $100,000 in taxable income.
All right, Megan. Well, so it sounds like if you're in a low bracket, maybe in your retirement, Roth conversion may or may not be something you should consider. But it's best to talk to a certified financial planner to get your individual income needs and situation, before making a decision like that. We have some upcoming workshops here at our office. We actually have one starting here in a few minutes shortly. A couple Saturdays from now, June 27th, we have Justin Spittler, CFP, hosting Tax Efficient Investing and Distribution Strategies. That's June 27th. That is from 10 to 11:30 a.m. Justin's going to talk about, how different, pieces of the retirement puzzle, if you will, how different investment accounts are taxed, how you should withdraw from different types of investment accounts, what type of investments you should put in different types of accounts, and so forth. Kind of what we were mentioning earlier, big ticket item planning in relation to your accounts that you have. We also have Charles Curry on July 18th, again from 10 to 11:30 a.m., talking about Social Security planning, basic rules, and claiming strategies. This is one of the biggest decisions, you can make in your retirement. So again, that is July 18th from 10 to 11:30 a.m. Josh, I see we had another text question come in. Do we have time on the air?
We sure do. We sure do. If we can get to Terry's question kind of quick here. Terry is expecting her first grandchild this year, and she just wants to know a little bit more about Trump accounts. Should she encourage her daughter to open up that Trump account for her grandchild?
I'd say yes. Congrats, Terry, on the grandkid. Anybody who doesn't know what Trump accounts are, it's a new savings vehicle for minors. If you are born between 2025 and 2028, you can elect to get $1,000 of free seed money from the government to get this account started. So you never want to leave free money on the table. So I would say, Terry, encourage your daughter to open that account and get that $1,000 of free money. Terry, you as the grandparent, if you like to, if you feel like you can afford to, if that's something to make you happy, you can contribute to the account for your grandchild. One important thing to note is that unless you are the parent or guardian opening up a Trump account, you should not open it yourself. The parent or guardian needs to open the account, not the grandparent if you are not the parent or the guardian. So I see we're coming up on the bumper music here, Josh.
You got it. Thank you so much, Dillon Little and Davis Hingtgen, a couple of great hosts of this here program On the Money on WDBO. If you've got a question, if you just maybe somehow just heard the word Trump account for the first time ever, and you want to know a little bit more about that, we do have Wynn Smith taking calls off the air, available to you live at 407-869-9800. 407-869-9800. You've just listened to On the Money, where we're planning tomorrow
today
with the Certified Financial Group.